Over the last 12 to 18 months or so, Jonathan Twomley and I have been talking about, warning about the pain that we expect to come to the commercial real estate market. We have done videos where we took $100 million property and made it worth less than $50 million. I think if our memory serves, we got it all the way down to 45 or 48 million bucks with very, very small tweaks. It was this discussion well over a year ago that made me believe that we are going to see a lot of pain be recognized. We've talked about the number of transactions done with BridgeNet the last couple of years. We have talked about the number of stupid money coming in at low cap rates and value add and retrading and all of these things. But I want to be honest with my audience. I expected more pain to be recognized here as we end 2024. Now, undoubtedly, we've had some spectacular blowups. We have had some spectacular write-downs on office and retail, and yes, some multifamily. But really, it feels like a whole lot of nothing has happened. And I'm sitting here as someone who said it was coming. I'm sitting here as someone who said I'm ready to pounce. And I feel like I'm twiddling my thumbs. So I want to ask Jonathan, is the pain coming? Is it something that extend and pretend and just has gone away and we're gonna skate by this iceberg and not hurt anybody? Jonathan, what say you?
Yeah, I don't think we're going to skate by this. I think that extend and pretend, it's interesting. Everybody saw what happened in the great financial crisis,
Mhm.
and they're like, okay, we're not going to repeat that mistake again. We're not going to rush to market with properties. We're going to, you know, basically kind of extend debt and hope that it sort of works out. And I think that what's happened, something that like is good for each individual player, right? Kind of, so for the people involved in a certain loan, makes sense to extend and pretend. Why sell now when values are down? Why refinance now when values are down? It's just going to create a big mess for everybody, so that they kick the can down the road. The problem is that when everybody's doing the same thing, you wind up just kicking a big problem, a huge problem down the road, just kind of postponing an issue. And I think what everybody's doing is sort of hoping that rate cuts will save everyone. But I think what's more likely to happen is that we're just going to have the crisis delayed to 2026 or 2027
Mm.
when all this debt comes due. Because I don't think we'll see extend and pretend beyond that. I think at some point all of these lenders are going to be feeling like we need to have our capital back. Um, they may even feel like, hey, we're willing to take a haircut to
Right.
get the capital back. Interest rates, I think, no matter what the Fed does, interest rates are going to be higher in 2026 or 2027 than they were in 2021 and 2022,
No
right?
question.
I think
Yeah,
there's
no
no,
question.
unless there's a major economic calamity, and then that creates a whole different problem.
Right.
But absent any kind of real financial crisis, there's no reason for interest rates to drop to the COVID levels, because that was a very specific COVID
Yeah.
related Fed policy, right? So, you know, and unless we have a lot of rent growth between now and then, we're just not going to see, and I don't think we're going to see that either. I mean, a lot of people are saying like, hey, the the supply of the new supply is going to slow down. The problem is it's all happening at the same time. Like the lack of new supply is kind of going to end around 26, 27.
Yep.
So it really would need to end right now to get substantial rent growth between now and then that hopefully could bail people out, right? But I just don't think the timing is going to work out. Um, and so I think what we're going to see is the crisis that you and I have been predicting is going to play itself out. It's just not going to play itself out as quickly as we might have been anticipating, because
Yeah.
everyone did extend and pretend. They didn't really fight about it. It
Yeah.
wasn't like pulling teeth to do extend and pretend last time because it hadn't been done before. Now it's like it's the solution to the problem that everybody
Yeah.
recognizes, except it just kicks the can down the road, right? And then everybody will be trying to release their properties to the market at the same time, and then there'll
Yeah.
be a rush for the exits.
I think that is such a great catch, and I agree with you 100%. And it's really funny when I think about what happened in the commercial market. I see the problem as an exact repeat of the great recession, right? It was
Mhm.
overvaluation, bad debt structures, bad assumptions, a lot of new money, not experienced, doing bad. It's just overpaying. Just it's the same thing in a different asset. But your point about the resolution, I think, is right, and something I missed and something I got wrong. I expected the ending to be very much like the Great Recession, and you're right. Everything it was the person that won in the Great Recession is who sold first. You
Mhm.
took the smallest cut, and I had assumed that banks would behave in a very individualistic manner, where they would rush to get their assets sold, so they take the smallest cut, and then that would be a cascading of effect. And nothing has been further from the truth. In fact, we have seen only the tippity top class A plus trade. Class B and C is not trading. Right? Transactions are down like 90%. It's just not trading. So I think you're right. I think, unlike last time where banks, the first bank to sell won, they've now looked at their playbook and said, well, yeah, we might win on this asset if we sold, but it's going to hurt all the other assets we own that's coming that are problems. So I think they went to the end of the playbook and said, you know what? Let's make extend and pretend really easy. I've heard from a lot of people, some of them have bridge debt. All the ones that I spoke to got an extra year, even
Mhm.
though their debt service is below one, right? Even
Yeah.
though, even though they have to do capital calls, they all got, relatively speaking, a 1 year extension. To that point that you really hit on the head is that won't go forever. This money was always intended to be short-term money.
Yeah.
They will call for that at some point. I do think there's a lot of hope and praying that rates go down 200 basis points, 300 basis points, maybe get to a debt service plus one where you can get some DSCR loan to hold the building longer. It's not coming. That's frack. It's
Yeah.
just not going to
I,
happen.
so the whole rush to sell scenario that you outlined, I think is going to happen. It's just not going to happen until
Mm-hmm.
2026, 2027, right? When extend and pretend runs out of gas, runs out of runway, then I think you'll see that start to happen. Now, the only thing I think that maybe would prevent that is that I think banks, and actually I'm starting to see this happen a little bit, where lenders are saying, okay, look, we're going to try to package this stuff up and sell it silently,
Yeah,
right?
I'm serious.
We're going to
I've
reach
been.
out,
People have told me. Yeah.
yeah, we're going to reach out to some operators that we like, and we're going to say, look, and I've literally seen this happen just in the last couple of days with somebody that I partner with, and they were basically told like, hey, look, we've got a couple of really good properties. If you want them, you got to take on these couple of stinkers too. And we're going to sell it
Yeah.
to you as a portfolio
Yep.
and at a good price. But the problem, the issue is like you're going to have to work out these
Yeah.
kind of these bad deals. But we think you can, which is why we're allowing you, why we're giving this package to you, right? So I think you're going to see stuff like that happening
That's.
off market in an
Yep.
effort to like avoid a rush for the exits. The problem is that not every property is going to fit into that. You're going to have onesies and twosies that are just, you know,
Duds. Just
yeah,
duds.
shit shows. Excuse
Yep.
me, but like,
Yeah.
and those are going to go to market and they're not going to sell. Yeah, I mean, I think you're still going to see. I just don't see any real recovery of prices in this market for some time. And I
Oh,
know a
this.
lot of people are expecting interest rate cuts to help this, but it's not. Like we saw this before.
Yeah. Yeah.
During the great financial crisis, interest rates went to zero. It did not help prices recover, right?
No,
Because all of that inventory had to be worked through first.
that's the
And
key. Yes.
yeah, and banks had to get comfortable again, right? Like just because interest rates go down
Yeah.
doesn't mean that banks are suddenly going to have an appetite to lend when they've been burned on this stuff. And also, if they're rebuilding their balance sheets, they're not going to be lending anyway, right? So
Exactly. People need to
the
hear this
whole
because, again,
yeah,
it's not only the inventory churn and revaluation, but your point is banks will not lend.
yeah, interest
And if you
rates,
can't you
people,
can't get debt, you can't transact.
yeah, I mean, people are talking about this on LinkedIn and other places as if like they're there's like, oh, interest rates go down, and there's some kind of like machine out there that spits out money, for real estate when the interest rate hits a certain level, right? It's just not true. There are banks in between that not only have to like decide to lend, but then they also have to decide what the spread's going to be. And the spread doesn't necessarily come down if, if they're feeling, if they've got agita, right? The spreads are going to be higher. So the actual mortgage rates may not come down that much, even if interest rates come down.
Yep.
So it, there's this human element that is at play here that I think people are not really giving enough credence to. So so don't really expect a great recovery in prices simply because interest rates come down. And the whole thing about like all the same supply and demand BS I've been hearing for years is just BS. Like that the fact that there's a housing crisis is not going to necessarily make banks feel better about lending, right? The fact that there's a lot of money out there looking for deals is not necessarily going to make banks lend more, right? It's not going to necessarily lead to price recovery because, if
No.
lenders get strict with lending standards as they always do after a crash, right? It's going to be less liquid. And that's what determines the price, not that there's all these players with equity on the side looking to buy because they're only putting up 25% of the money, you know, and the banks are putting up the rest. They're the ones who have the biggest risk in these deals, and they're the ones who are going to be
Yeah.
cautious. In addition to all the other problems that the banks have because of what's been going on.
Yeah, you've said something a couple of times now I want to go back to and really make sure I understand it. So we both think the pain is coming. I think you have said twice now that you think it's 2026 and 2027. So you think obviously given that I guess we don't see it next year.
Yeah, I don't think so because I think next year is the middle of extend and pretend,
Got it.
right? Like if you had 3-year bridge that originated in 2021 or 2022,
Right. Yep.
then as most of it did, I mean, just a massive amount of loans were issued in those 2 years, right?
Hmm.
And so if you have, and it was all 3-year bridge
Yep.
with 2 years extensions. And so what you're seeing is all of the stuff that 3-year period started to end this year, more of it will end next year. If they got their extensions, that's 2 more years.
Yep.
Sometimes people have been able to negotiate even further extensions, but 2027 is kind of when all this runs
Yeah.
out, right?
Yeah, because
And
as I understand it, you play in this world. A lot of this bridge debt is short-term money that has a clock on it, right? These are funds that got investments from rich, family offices, and they usually have a clock on it, right? Maybe it's a 5-year hold, it's 7 years, but there's clocks on this money, right?
yeah, and a lot of this money is actually borrowed itself, right? So
Oh,
these funds borrowed the money from somewhere else, right? And their whole game was we're borrowing at super low interest rates. We're locking in a spread. And now they're really in trouble because their interest rates have gone up, right? Um, and they're also on the hook for the money, right? So there's a kind of a cascade of people who are on the hook for this. It's not simply that these bridge funds just have like their own money to lend in a
right.
lot of cases. I mean, sometimes it is equity that's invested by wealthy people, but sometimes it's borrowed money, right?
Gotcha,
So,
gotcha. Yeah, so let's play out 2025 because again, I one of the things that I always try to do is look at early signals because if you could see a pattern emerge, you can play the game of chess or checkers, whatever you want, pretty well. So one of the things that I would expect to happen in 2025 is a lot of listing growth. Now, why
hmm.
would that be? Because again, I've been in this movie before, and if you are an owner of a building that's in trouble, you're going to try to list it and get some dumb 1031 money or some dumb investor to come in and take the problem off your hands. And if we're going to see a bunch of losses in 26 and 27, I would expect listing growth of, class B and class C assets to grow next year. Probably at stupid prices, what I call wish pricing.
Hmm.
But does that make logical sense where we might see a lot of listing growth, but it's bad listings, bad pricing next year?
Yeah, I mean, that's interesting. I don't really know. I mean, I kind of feel like transaction volume is going to continue to be depressed in 2025. It's
Oh,
not going to be the
yeah, to
recovery.
be
Yeah.
clear, I'm only talking about listing growth, not
Yeah, I hear.
transactions.
Yeah, no, I hear you. I get it. I'm not really sure. I mean, there there's definitely going to be there's like a whole new, all of the 2022 vintage bridge loans are coming due next year. So you may see that, and maybe, you know, if there's less appetite amongst the lenders to extend and pretend that, tranche of loans, then maybe you will see that listing growth. And I think it'll play out the way that you say, where the listing price is going to be the price that, you know, makes everybody whole.
Right.
But the problem is that, the prices are
It's
down
not
by
even close.
20% or more. Yeah, prices
Exactly.
are down by 20%, and you're not there, right? So nobody can underwrite loans on that, new loans, fresh loans on that basis. It just won't pencil out. So the only transactions that'll happen will be for like the cherry picked best properties with buyers who have the ability to put up a lot more equity than normal, right? So it's like the safety money, right? As opposed to the people looking to make money, because they're the people who can come in with more equity will buy deals. And I think you'll just see a lot of deals that just don't trade, right?
Oh,
And just like we've
it'll
seen in the last year. Yeah.
days on market are going to explode if the movie plays out how I see it in my head. Days on market are going to explode. Listing growth is going to explode. The other thing I want to talk about to potential buyers, if I'm right, and again the movie plays out something like last time, is really watch the asset. What do I mean by that? These listings, if it goes the way I think it will, wish pricing, all of that, they are going to get increasingly bad. Properties are going to
Hmm.
every month be in worse shape. Why is that?
Yeah.
Because the owners know they're going to lose. They're not going to repair anything. And if they do repair
Yeah.
something, they're going to band-aid it. And I saw, again, a building that we own today. It first went out at 1.4 million bucks. It didn't trade for over 18 months. Extend and pretend. The bank finally took it back. It got in there. It was a disaster. We bought it for half price. Bought it for 700 grand. And the bank had to loan on it. And all of this because it was in terrible shape. So be careful, right? I do think we're going to see
No.
B and C properties listing growth. They're going to be listed at horrible prices, and the owners aren't going to take care of them. So it's going to be a mess, and that's why I think you're right. 2026 and 2027, several years past when I thought this would come, is when the real crash in values. Because again, think about this. You're going to have properties that are overpriced by 20% when they go out, and then they're going to degrade, and then they're going to be worth 40% or 50% less when the
And
bank takes
then
them back.
and then think about this too. Like if you have money to deploy, right? What are you going to buy? Because there's going to be a lot of distressed Class A out there too, right? Where Class A that couldn't be leased up or is partially leased up, and those construction loans are coming due, and they can't be refinanced into permanent debt, because the underwriting has been blown up
Oh
by
yeah.
the oversupply and the rise in interest rates. So if you are sitting on cash, like what are you going to buy? Are you going to buy the distressed like 2-year-old property, or are you going to buy the distressed 40-year-old property, right? I mean,
Mm-hmm.
it's a no-brainer,
Oh,
right?
I
So
agree.
so I
I
think
agree.
I think that those older properties are really going to languish, and it'll be up to like a real price correction, and then the real kind of people who can really roll up their sleeves and rehab properties coming in and buying them at serious distress and
Oh
discount rates. But it's going to take like I just think it's taking longer this time because everybody extended and pretended, right? They
yeah, we
all
we
tried
created
to
an
avoid
air
the
pocket.
mistake of.
Yep. Yeah,
Yeah.
I think you're right. I think that catch, that thing you opened with, is that everybody realized, because again, last time the first bank that sold won, but they
Right.
kind of skipped to the end of the playbook because they know they may have won on a single transaction, but they lost when they put the portfolio together. Now they're
Right.
like, hey, we're just going to move this to the end. We're going to create this gap, but it doesn't end well. I think, again, like my example in 2010 with that building we own, I think there's a chance that when you look at the last trade on an apartment building, B or C, when it finally retrades in 26 or 27, it might be 50% off.
Yeah.
in some
Yeah.
in some cases, no question.
I mean, listen, there's like reversion to the mean, right? But for things to revert to the mean, they have to go past the mean in the other direction
Correct.
first, right? And so when I started out buying property and I was buying, C deals and B minus deals, they were trading at 8 caps, right?
Yeah.
Sometimes higher than that. And then these properties got down to 3 and 4 caps. And I remember just looking at this and trying to tell people like this makes
What
no
are they doing?
sense. This
Yeah,
is
I
yeah,
agree.
this
That's
will
why
this
I
will
sold. I
not
sold in
yeah,
18 because of that. Yeah.
yeah, this will not end well, right? And everyone was like, oh no, how's it was the same old thing. Housing crisis,
Blah
Fed
blah
can't
blah.
raise rents,
Yeah.
blah blah, federal budget deficit. Like none of this was relevant. It's it's like the market kind of will rise until it can't rise anymore, and then it stops rising and it crashes really fast, right? And that's kind of like what happens. There's no Goldilocks market forever.
Yeah.
And but what's going to happen is exactly as you describe, that these properties are going to deteriorate because
Exactly.
there's no incentive to invest in them. They may not even have the money. They may not be able to do the work if they wanted to because they don't have the
Some
money,
cases, yeah.
right?
In some cases,
Yeah.
yeah. Yeah.
So you'll see the whole cycle repeat itself. There are going to be people who make fortunes buying at rock bottom prices, but unfortunately, they will not be the same people who bought at the top, right?
Yeah. No, that will be a different person.
Yeah, yeah. So
Yeah.
um, that whole
Yeah. It's really
generation of
funny
investors
that
are kind of
out. They're
screwed.
they're they're out and they'll probably never come back. Like
Yeah,
there's a
yeah,
bunch of new money that came in. It's the same story all the time, right? All the
yeah,
new money came in, like your market cycle. You've done a presentation on
yeah.
my channel about market cycles, and it's happening again. I really now talking this out, we're going to see listing growth, days on market. We're going to see quality degrade. We're going to see foreclosures in 26, 27, and we will see B and C class properties trade for 50% discounts to their last sale price. It happened last time. It'll happen again. It's just
Yeah,
farther out than I expected because of this air
yeah.
pocket.
And I think that like what people have to understand is that okay, like history doesn't repeat itself, but it always rhymes, right?
Right.
Like this this happens in pretty much every cycle, but it'll happen in a different asset class or for a different set of circumstances. But what you see is the same basic pattern every time, which is the cycle starts out with a lot of distress because of a big mess created at the top of the last cycle, right?
Yep.
It's going to take a while to clear. It'll be slow for several years, but that early, the people with cash will move in early. They'll start buying, and then the whole thing will start again. And as the market climbs, all those people who kind of became aware of real estate during the crash will be like, oh, real estate's a bad idea. It's a bad idea. It's a bad idea. But as they see more other people making money, they'll gradually be drawn in, and they usually get drawn in at the top.
Yeah.
And and inevitably the Fed will wait too long to raise interest rates. They'll allow a huge bubble to grow, and we'll just see the whole thing. You'll hear the same thing again. This time is different,
Mhm.
right? You know, this past cycle, nobody actually used the words "this time is different" because they learned their lesson, but they were essentially saying the same thing. It was all the Fed can't, nothing can change because the Fed can't raise interest rates because of the federal deficit. And oh, look at the housing crisis. So, rents will continue to rise. And like everyone forgot about the business cycle. They forgot about the
Mhm.
construction cycle. Like it's like these things are still existent, you know. So it's here we are again.
Yeah. I feel a lot better having this conversation because again, I don't like being wrong, and I was wrong thinking that this pain would come next year. You're absolutely right that extended for 10-year in mass was not anticipated. And but the pain is coming, and I actually think it will be worse now, right?
Mm.
Because again, I think to your point, I think all of this is going to show up at the same time because this
Well,
debt structure has clocks on it.
yeah, and here's the thing, like I think what people are not focused on necessarily is because of the low interest rates in 2021 and 2022, the sheer volume of multifamily that was traded in those 2 years is
Record,
just
record.
enormous record, right? So, I mean, you can just look at the charts and you just see the spike in those 2 years of what transacted. which means that the amount of debt of that vintage is just enormous. And
Biggest we've ever seen.
almost, yeah,
Yeah.
and almost all of it is short-term debt, right? There are very few
It's the
people
only
who are
way deals
buying,
got done. It's the only
yeah,
way deals got done.
unless you really had a lot of cash and you're very conservative and you're like, hey, I'm going in because I don't care about the return. I'm going in at,
Yeah, maybe.
40%, 60% LTV and fixed rate debt.
That was
But
such
very
a
few people
small
did that.
percent. Yeah, very
Yeah.
small. Yeah.
So it's all coming due at the
It
same
is.
time and more than ever before. That's the thing. More than ever before. I mean, you've made this comparison many times. It is very much like what happened in single family homes in the GFC, right? Just
Absolutely.
the enormous volume of stuff that, got built all at the same time and then was suddenly on the market and there just wasn't any appetite to buy it, right? And you'll see the same
No.
thing. There just won't be enough players to buy all the stuff that's on the market. And so
And your
what you'll
point about
see,
banks is even more important, right? So you got all these buyers that'll be out because they were burned. So you're going to have less participants. But don't forget that the next leg of the chair, the banks, that's why the Great Recession was horrible. I don't know if people realize this. One of the reasons that my market, like I have a property that went from 300 grand to 75. The reason a lot of that happened is because banks refused to lend on single family homes.
yeah,
Banks refused to lend to investors. Folks, I was buying properties all the way down and banks told me no. So what happened? I had to go get hard money at 12% to buy, and I had to put 40% down, right? 3 points or whatever the heck it was. I had to pay less. If banks would have done loans and participated in the residential, it probably would have saved 10 or 20% easy. It was some of the safest loans they could have created below land value. It's crazy.
yeah. I mean, I think we'll see some of that stuff happening with multifamily as well.
Absolutely.
When the bill comes due for this, because also the thing, think about also. I mean, even if lenders have an appetite to lend, or banks have an appetite to lend, right? So much of all this debt was bridge debt, right? A lot of these lenders are belly out, right? They're
They won't be
all
around. They're
underwater.
not going to
They won't be,
exist.
yeah, they won't exist, right? So there won't be like the next set of bridge lenders to come in, or these guys are not going to be able to like lend to nearly the same extent that they could before. So there's going to be a lot of like there's going to be a huge liquidity issue in the market, and like you
And
said,
yeah,
it's going to so people are going to. I'm telling you, I mean, the more as I'm thinking this out, as I'm talking to you, it's like, hey, you know, hoard your pennies, guys, because
yes,
you're going to be able to buy stuff if you have cash super cheap. And I know that, like, you know, you and I kind of in the background, what we're talking about is a lot of these bigger deals, but the same thing is going to happen with these smaller deals. And maybe they
yeah.
weren't bridge loans or whatever, but I think there's going to be a lot of like these smaller sort of 5 to 20 unit deals
That's where
that
I'm focused. 5 to
where
50s.
yeah,
Yes.
where the owners got greedy, refinanced at the top of the market, right? When they didn't necessarily have to, right? But they're
Yes,
like,
exactly.
right?
They didn't have to, but hey, they saw it. Yeah. Yeah.
Yeah, they saw these low interest rates. They took a huge chunk of money out of the property, put it in their pocket, and now they're wishing they hadn't. And they're gonna, that
Yeah.
debt's gonna come due, and they're not gonna be able to refinance it. Because
And
also
then,
yeah, sorry, just
yeah.
one point. I wanted to make this before, and I remembered it again. The thing that everybody has to remember is on a refinance, you can only get 70% LTV
Right.
on a refinance, right? So think about like how much, like if you've had a 20% decline in values at least, right? And you can only get 70%, right? Like what's the delta there? How much cash do you have to put in to
Mm.
get 70% LTV when you've lost 20 or 25% of your value, right? I
Well,
mean,
let's
it's
let's just do
ugly.
the math real quick. I mean, if we took
Yeah.
$1 million property, they cashed out at the top, it's down. So they got a 700K loan.
Yep.
Now the building's down 20%. So now it's 800 grand. And a 70% loan of that is 560. So you got to come up with 140 grand roughly.
Yep.
Yeah, that's a hell of a check to write.
Yep. Yep. So, I
Yeah.
mean, we're going to see a lot of this, a lot of
Yeah.
this.
Well, let's tie one more thing together because as I'm playing with this with you, I'm getting more and more excited. But we've talked about values coming down. We've talked about debt time bombs. We've talked about banks not wanting to lend, and we've talked about quality of building. So let's put the bow on this. if this goes the way we think it is, and buildings are going to deteriorate, there will be banks that maybe want to lend, but the asset won't be of quality that they
Yeah.
can lend, which
Yeah.
is going to mean prices have to go down even more. This is just going to be a wild catch 22, because again, I
Yeah.
think there will be an appetite from some lenders to kind of rebuild, but the quality of these assets will be so bad that they can't lend on, right? It'll be a bank restriction or whatever they're going to call it, a covenant. And once that happens, man, prices are going to tank.
Yeah, I mean, and I think it's going to be like a really bifurcated market, right? It's going to be, it was the best of times, it was the worst of times. Like if you have a high quality asset, you'll probably be okay. But if you have, I
You have a
mean, you might
newer
not
high
get the
quality
value.
asset. Yeah,
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 exactly. You might not get the value that you want, but I mean, you probably can survive,
yeah.
get into the next cycle and be okay. But the the low quality stuff, all that C property that was bought to do value add, that like
Yeah.
where they didn't actually do the value add, or they were just planning on flipping it, and now it's just where they tried and they didn't get their, they didn't get the rents they expected, right? And all that stuff. I mean,
Ugh,
and now it's
yuck.
10 years older, and it's like, all the lipstick on the pig like doesn't do anything to the
Yeah.
pipes and the, inside the
Yep.
building and what's behind the walls. I mean, it's going to get pretty ugly.
All righty, folks. I'm getting excited. I don't know about you. I'm looking for 50% discounts. I've seen this movie before. It is wild. Largest wealth generating of my career thus far was that part of the cycle. It's coming again. It's not coming as fast as I wanted, but that's okay. As somebody who has residential property, also, I get another year or two of residential growth, especially if the government comes in with first-time homebuyer programs. So maybe in the resi market, I see an extra 5-10% bump, and then I just do a bunch of 1031s, 50% LTVs into distressed apartments. And we just repeat the movie that we did last time, except at a bigger scale. I'm excited. 50% discount, 26, 27. Let's go.
Yeah, I think it's definitely plausible to see that scenario play out. So
Oh, man, I'm excited. I have a cold. I feel terrible, but now I'm excited. So you made me feel a little bit better. Jonathan, where can people find you?
Yeah, well, listen, I'm really active on LinkedIn, so that's the best place to get in touch with me. I'm there every day posting and commenting and DMing people, so feel free to reach out. I would like to also just, let everybody know that my school group, known as Apartment Investors Club, we just started on school, but this is Apartment Investors Club has been around for a long time. I am raising the prices pretty substantially on September 16th. So
Ooh,
right now, it's $97 a month. If you join between now and September 15th, you can get that price and lock it in forever, but it's going up to $250 a
ooh.
month on September 16th. So be sure to get in there now while you can at the cheaper price.
Very cool, Jonathan. Thank you so much. Take care.
Absolutely. You too.